Wondering how to balance wealth creation with financial security? Are you looking for a plan that grows with you? Does the ABSLI Wealth Infinia plan have what it takes to adapt to your changing financial needs? Let's find out the answers to all these questions through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. So before analyzing whether this will be a good fit for your investment portfolio or not, let us first understand a few basic details about this policy. So Aditya Birla Sun Life Insurance Wealth Infinia plan is a unit-linked non-participating individual life insurance savings plan. And some of the key features of this policy is that you have the flexibility to choose between two plan variants. One is a milestone variant which gives you coverage till the age of 85, and another is a legacy variant which gives you coverage till the age of 100. And you also get life cover throughout the policy term, which ensures that your family is financially secure even in your absence. And you get the choice of choosing from 5 investment strategies and 18 fund options to suit your varied investment needs. And you also get wealth boosters and loyalty additions which will be added periodically during the policy term to enhance your fund value. And the return of your mortality and premium allocation charges at maturity also boost your fund value. The tax benefits will be applicable on the premiums you have paid and the benefits you have received as per the prevailing tax laws. So these are the key features of this policy. Now let's move on to understanding the benefits we get from this policy. So for both the variants, the benefits are more or less same. Now let's take a look at the death benefit. So death benefit is given to the nominee or the legal heir in case of unfortunate death of the policyholder. So as you can see the options mentioned in this screen. So out of these options, whichever is highest in value at the time of death of the policyholder, that will be given as death benefit to the nominee or the legal heir. So the options are fund value as on date of intimation of death, or the sum assured. The sum assured also be reduced if you have made partial withdrawals during the 2 years which immediately preceding the date of death of the life insured, and also 105% of the total annualized premium or the single premium received till the date of death of the policyholder. This can also be reduced by all partial withdrawals you have made during the 2-year period immediately preceding the death of the life insured. So these are the death benefit. The maturity benefit is if you survive till the end of the policy term, then you will receive the fund value in a lump sum or other structured payout using the settlement option. Additionally, all the premium allocation charge and mortality charges collected excluding GST over the entire policy term will be returned to you at maturity. And you also get loyalty additions. So loyalty additions are benefits which are added in the form of additional units to the policy which shall be credited only if the policyholder has paid all due premiums under this policy. So loyalty addition will be calculated as a percentage of your fund value, and wealth boosters will be calculated as a percentage of your fund value and will be allocated as additional units to your fund starting from the end of the 10th policy year and every 5 years thereafter, provided you have paid all your due premiums under this policy. Now let us take a look at the 5 investment strategies and the 18 fund options available under this policy. So first let's take a look at the fund options. So the fund options for you to choose from are Liquid Plus Fund, Income Advantage Fund, Assure Fund, Protector Fund, Builder Fund, Enhancer Fund, Creator Fund, Asset Allocator Fund, Magnifier Fund, Maximizer Fund, Multiplier Fund, Super 20 Fund, Pure Equity Fund, Value and Momentum Fund, Capped Nifty Index Fund, MNC Fund, ESG Fund, Small Cap Fund, and Linked Discontinued Policy Fund. So there are all these options, and these fund options are allocated based on their risk profile and the asset allocation they have, like debt, money market, and equities, and you can choose based on your investment needs. Now let's come to the investment strategy. So there are 5 options. First is the systematic transfer option, where if you have chosen this option, then your premium shall be allocated to the Liquid Plus Fund option, and thereafter monthly 1/12 or weekly 1/48 of the allocated amount shall be transferred to a segregated fund of your choice. So the percentage allocated to chosen funds should be in increment of 1%, which can range from 5% to 100%, and the total allocation across all funds must be 100%. You can choose up to a maximum of 4 segregated funds out of Income Advantage Fund, Enhancer Fund, Maximizer Fund, Super 20 Fund, Capped Nifty Index Fund, Multiplier Fund, Value and Momentum Fund, Creator Fund, MNC Fund, ESG Fund, and Small Cap Fund. Now let's take a a look at the return optimizer investment option. So your basic premium will be invested in the maximizer fund, which is an equity fund, and it will be tracked every day for any gains, and the gains from the maximizer fund, if it reaches 10% or more of the net invested amount, that amount equal to the appreciation will be transferred to the income advantage fund, which is a debt fund. So your gains will be protected from future market volatility in this way. And you also have the self-managed option. So as a policyholder, you have the full freedom to control and switch from one segregated fund to another among these 18 segregated funds. So in this option, you have this complete control and freedom, but the only requirement is that the percentage allocated to any fund should be an increment of 1%, which can range from 5% to 100%. So the total allocation across all funds must be 100%. Now let's take a look at the smart investment option. Your portfolio will be structured as per your maturity date and risk profile, which can range from conservative, moderate, aggressive. So your annualized premium will be allocated between the two funds, maximizer equity fund and income advantage fund, which is a debt fund, in a predetermined proportion. Over time, what will happen is the allocation is managed in such a way that it will automatically switch from riskier assets to safer assets progressively as your plan approaches maturity. And this proportion which you invest in maximizer and income advantage fund will be predetermined, which you can refer to in detail by referring to the policy brochure. Next is the life cycle investment option, which is also your annualized premium will be allocated between two funds in a predetermined proportion based on your selected risk profile and your age when the premium was invested. So this percentage allocation is also predetermined, and if you want to know about it more in detail, you can definitely refer to the policy brochure. So these are all the investment strategies and the fund options for you to choose from to start your investment journey through this policy. Now, as a ULIP policy, this policy also has charges under it. So let's take a look at the various charges under this policy. So first is the premium allocation charge. So this is levied on the annualized premium based on the policy here and what kind of annual premium you pay and what kind of variant you have chosen. It all becomes down to that. So based on that, they will charge your premium allocation charge. Next is the fund management charge. It ranges from 0% to 1.35% based on the funds options you choose to invest in. So basically, fund management charge is they are charging for you to manage your fund. So basically, this charge depends on the fund options you have chosen to invest in. There is no policy administration charge, but there is still mortality charge, which is charged based for providing you with life cover, and it is charged based on your gender and your age when you have chosen to invest in this policy or enter into this policy. So it also differs. If you want to know more about it in detail, you can definitely refer to the policy brochure. Next is the surrender charges. This charge is levied on discontinuance or surrender of this policy, which will be based on the year of discontinuance or surrender. So the premium amount and the fund value. So basically, all these factors will determine your surrender charges. There is no miscellaneous charges. Now, if you take a look at all these charges, these are additional costs to the investor. So in general, other market linked products, like if you take a look at mutual funds, they do not impose such substantial charges, so which makes this ABSLI Wealth Infinia plan not that much attractive, because it is posing such substantial charges which will definitely impact your returns in the long term as well, because the net premium you're investing is not invested just like that. It is invested after deducting all these charges. So you need to consider this factor also while choosing to invest in a ULIP policy like this. Now let us take a look at the advantages and the disadvantages of investing in the ABSLI Wealth Infinia plan. Let's start with the positives here. There is no limit on the number of switches under the self-managed option that can be made in a policy here, and all your switches are free of charges. And after the first policy here, you can change from one investment option to another, and under the self-managed option, you can choose to redirect future premiums as well. And if you have completed first 5 policy years, then you have the option to decrease your premium by up to 50% of the original amount. You also have the option to reduce or increase your premium payment term. And unlimited partial withdrawals from the fund value are allowed at any time if you have completed 5 policy years and also you are at least 18 years old as a policy holder. And for the maturity benefit, you may opt for a settlement option where the company will continue to manage the fund and make periodic payments for up to 5 years. And systematic withdrawal facility is an automated partial withdrawal facility that can be opted by you anytime during the policy term. Now, if you take a look at the negatives, that this policy doesn't permit any policy loan under this, and there is no liquidity available during the first 5 policy years. And also, as you can see, this although the sum assured is also inadequate, and although this plan refunds some of the charges, it does not account for the time value of the money. So maybe the charges you paid at the time would have been 100 or 250 rupees or something like that, but the time value of that money due to inflation would have risen, right? So even if they give you 250 rupees after 20 years or 15 years of the policy term, it will not be worth the same as it was then, right? So that should also be accounted for. So these negatives shows you the potential risk you might be undertaking by choosing to invest in this policy. So it's better to be carefully go through all these factors and then decide. So now, as we have understood this policy and how it briefly works, so let's move on to the analysis part of the video, where we are going to analyze the internal rate of return, which is the IRR of this policy, to see what kind of returns we get. Because now we looked at the benefits and advantages and everything, right? It can seem appealing, but what matters at the end of the day to an investor? The returns we get in a hand. That's why we are going to analyze the IRR of this policy. Now, just for calculation purpose, let us assume that a 35-year-old male buys this policy with a sum assured of 20 lakhs. The policy term is 20 years and the premium paying term is 10 years. So the premium amount pays annually is 2 lakh rupees. He has chosen the milestone variant. So on payment of the regular premium, he will get the fund value as a maturity benefit. Now, to calculate the IRR, we are going to calculate it based on two assumed rate of future investment return. One is 4% per annum, which is for the worst case scenario, because this is an ULIP plan, so the returns are also based on market conditions, right? So we are choosing to calculate it based on two assumed rate of return. So 4% is for the worst case scenario, 8% per annum is the best case scenario. These rates are not guaranteed in any way, and they do not represent the upper or lower limits of potential returns. This is just for an example purpose. So if we calculate the IRR at the 4% scenario based on the ABSLI Wealth Infinia Plan maturity calculator, then you get a fund value of 30.88 lakhs with an IRR of 2.82%, which essentially provides no value addition. Like basically, you invest in this policy for so many years and you take the risk of investing in a ULIP policy in which the market conditions affect the returns. So you're taking this much amount of risk for such a huge long-term period, and still you're getting a rate of return of 2.82%. Basically, IRR of 2.82% is the same as the interest you get at a savings bank account. So if you did not invest anywhere your money and just kept it at your savings bank account all these years, even then you can get a better return or even a similar return to this. And the worst part about this is that 2.82% is not even guaranteed. That means the returns at the IRR can go even lower than this. You need to consider this. Then in the 8% scenario, so in the 8% return scenario, if you calculate the fund value and the IRR based on the ABSLI Wealth Infinia Plan maturity calculator, you get a fund value of 55.82 lakhs with an IRR of 6.73%, which is similar to debt instrument like bank FD. So basically, it's a return which is similar to FD, but even in FD you get a guaranteed return. But so here it is not guaranteed. That means it can go lower than this. And also, it is not a debt type of policy, right? It's a fund which we take risk based on the market condition. So it's a market linked instrument. So if we are taking the risk for such a huge long period of time, that means we are expecting higher returns, because basically risky products like this, which are market linked instruments, usually perform well in the long term. That's why we take that risk. But here, even after taking the risk, it's only giving us a return similar to debt instrument, means it is not any justifiable return. So as you can see, this returns of the ABSLI Wealth Infinia Plan is not on par with other market linked investments. So the risk is high, but the returns are similar to debt instrument, making it unworthy of the risk taken. So the risk return aspect is lacking in the ABSLI Wealth Infinia Plan. So as we can see from our ABSLI Wealth Infinia IRR analysis, that it does not effectively support long-term wealth accumulation. Additionally, the sum assured is also too low. So to achieve comprehensive coverage and accumulate a substantial corpus, we are going to explore an alternative investment strategy and do a comparative analysis where investment and insurance are handled separately. So using the previous example, we will compare the results of this strategy. Now for life cover purpose, we have chosen a pure term insurance policy, but we have maintained similar metrics to the ABSLI Wealth Infinia plan for fair comparison. So as you can see, this pure term life insurance policy has a sum assured of 20 lakhs, which the policy term is 20 years and the premium paying term is 10 years, and only the annual premium here differs. There we paid an annual premium of 2 lakhs, but here we are only going to pay 16,600 rupees. So under this policy, what we are going to do is, by opting for a pure term life insurance policy under this strategy, we have saved 1,83,400, which can be invested for wealth accumulation process. So what we are going to do is, you can choose any investment vehicle based on your risk profile, your risk appetite, but here we have chosen a market related instrument, an ELSS mutual fund, which has, if you take a look at its track record, that it has consistently given 12% per annum if you have chosen to invest in it beyond 7 or 10 years. So for a long term period like this, it has given better return. So based on that, we have chosen ELSS mutual fund, and also these investments are eligible for tax deduction. So though redemptions will be subjected to capital gains tax, it also has tax benefits as per the section 80C. So now if we calculate the IRR of the pure term plus ELSS mutual fund combination, we can see the pre-tax value of the ELSS fund is 1.11 crore, but after accounting for the capital gains tax, the maturity value is 1 crore rupees, and the IRR for the ELSS investment combined with the pure term life insurance policy is 10.67% based on the post-tax return only. So even after paying tax for the capital gains tax, we are still getting a return which is higher compared to ABSLI Wealth Infinia plan, and also the IRR you get here is definitely inflation beating return. So with the accumulated corpus here, you can comfortably achieve your life goals as the returns are higher than the economic inflation rate. So the investment strategy is more effective because both the insurance and investment components operate at their best when not combined. So the low risk adjusted return and the inadequate sum assured makes the ABSLI Wealth Infinia plan less suitable for our investment portfolio if you choose to invest in it for a long term period, comparing the risk we are going to take. Finally, let us find out what is the final verdict on ABSLI Wealth Infinia plan based on our analysis. So as you can see, this plan fails to effectively serve both investment and insurance purpose. The return analysis shows it rarely helps in achieving the necessary corpus to meet life's financial goals, and high charges reduces your investment amount, which affects your returns long time. And the insurance covered provided is also not inadequate, and it lacks proper backup for eventualities. So a robust safety net is crucial in financial planning, which the ABSLI Wealth Infinia plan does not offer. And essentially, this plan falls short in every aspect, making it unworthy of the associated risk, and also it has high agent commission. So for effective life cover and wealth accumulation purpose, it's better to opt for a pure term life insurance policy and build a diversified investment portfolio. This approach works well if you avoid the complication of combining insurance and investment. And if you have any doubts on whether you need to invest in this or not, and you're struggling to make a decision, then you can always consult with a certified financial planner for assistance in building a resilient investment portfolio based on your risk appetite, time horizon, and financial goals. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.